Hello, fellow dividend investors. It's that dividend guy coming at you with another Robinhood portfolio update. Happy Thursday. Hopefully, everybody had a great green day in the market. I hope everybody made some money. You know, I always wish the best for my viewers and subscribers. So, today we're going to look at the overall portfolio performance. We're going to look at the individual holdings, and then we're going to look at the growth stocks as well. So, today we made a little bit over $60 in the stock market. For the week, we are down about $1,000. For the month, we're down 20, almost 2,200, down about 9%. The 3 month mark, we're down 1,067, or almost 5%. For the year, we're only down $257, or 1.24%. And then all time, we're actually negative $25, or down 0.12%. So that's not too bad. And keep in mind, these returns don't include dividends, so I definitely would be up if dividends were included. But I'm not doing too terrible, guys. It's crazy how much the market can fluctuate because we're green today, but then everything else is red. But it doesn't freak me out. One of the things that you guys need to keep in mind is I'm a very long-term investor. So I'm in my 20s, and I've been investing. Sorry, I got a little bit of a cold, and I've been investing for a little bit over 2 years now. And the thing is, volatility in the short term does not bother me at all. Like I said, I'm doing this in my 20s, but the goal is retirement. So, I mean, average retirement age is like 65. So, I'm going to be doing this for 40 years. Hopefully, I don't have to. The goal that I'm trying to shoot for is to retire by like 40. But I have when I was working, I was putting more than $1,000 in the market every month. So if I keep that up, it'll be even shorter, or I can just pile in more money and make this even bigger. But I'm a very long-term investor, so when I see this like down $1,000, eventually I'm gonna have like a $200,000 portfolio, so or 500,000 or $1 million portfolio when I once I hit like 45. So I'm not super worried about being down by a grand. So that's a month I didn't invest, and then on the month mark, that's 2 months that I didn't invest. But the funny thing is, I haven't been able to put money in the market for a couple months anyway, so that doesn't really bother me. I could literally make up that money um, by the end of the year. So it doesn't bother me at all. So let's jump into the individual holdings, starting with one of my personal favorites, Realty Income. Uh, 15 shares, $880 of market value. Average cost is $45.38. 4.3% of the portfolio is in Realty Income. Up about $200 today, up about 30%. Really happy with this holding. I love it, and it will be one of the core holdings in my portfolio. Next, we're on to the quarterly paying stocks. With Altria, Dividend King, we have 149 shares, $5,700 of market value, 43.61 is our average cost. 28% of the portfolio is in Altria on the dot, which is kind of nice. We're down $776 right now, down about 12% on this stock, but we have a dividend coming in of $128, and that will be going to AT&T. That's the goal. So if it pays me in October, I'm going to use it for the cheapest stock that I can buy in my portfolio, or the most down stock that I can buy for the next set of months. Which right now that is definitely AT&T, because Lowe's is up and AbbVie is also up. So AT&T is the only one I'm really willing to buy right now within the portfolio. I think it's a steal. Next, we have Coca-Cola. Uh, we have 20 shares, about $990 of market value. Average cost is $51.26. 4.83% of the portfolio is in Coca-Cola, and we're down $37, down 3.66%, down less than a share, so that's really not that big of a deal. We do have a dividend coming in of $8.20. This is my goal stock for this set of months, so I will be putting money into this once I get back to work, and the goal is to be dividend efficient and drip 5 shares of this every single time it pays. Next, we have FRT. This one is one of my personal favorites as well. I love that it's a dividend king, and I love how strategic they are with where they buy and place their real estate, and how well they put it around, like population wise and income wise. I think they're very, very good at what they do. And the tenant mix is crazy. I looked at an updated list. They have Starbucks, Tesla's even on their tenant list. Um, of course, a bunch of retailers, Best Buy, and other stores like that. But the ones that really made me excited were Tesla and Starbucks, because I plan on owning Starbucks stock. So why not The crazy thing about that is, and I'm doing it with Walgreens with Realty Income as well. I'm getting paid 2 times for the same real estate. So FRT is paying me a dividend for holding it, and it owns the land that Starbucks. So Starbucks pays them rent. So Starbucks is one of their clients. So not only do I get paid by Starbucks because it also is on my watch list, so I'll get paid by Starbucks, and they pay Federal Realty, and they pay me. So now the company that is paying rent pays me, and so does the company it's paying, which is great. So I'm getting paid by 2 separate companies for the same piece of real estate, which is phenomenal. But anyways, we only have one share of Federal Realty. Sorry, I always say Realty Income as a habit. It's 72.34 is our market value. Average cost is 113.40. So we are down significantly, but that's not a huge deal because we only have one share. So I was very strategic about that. 0.35% of the portfolio is in FRT, and we're down $41. So not even a share here. Not really worried about it. Down 36%. We do have a dividend of $1.06 coming in, but that will be a lot bigger. I love the tenant mix for them. I love the diversification. I love the placement of the properties, and I love that I can get paid by two ways for the same piece of real estate. So that's kind of how I'm hacking it and thinking about it, and it made me a lot more excited when I saw that I saw companies that I own in the portfolio that Realty Income owned, and I saw the same for this REIT as well. So I'm getting paid twice for the same piece of real estate by 2 separate companies, which is awesome. But I am very bullish on FRT. It will be one of the bigger positions in this set of months just because it's real estate, and I do want real estate to be a big portion of my portfolio. I want it to be about 25% um, of the portfolio, and seeing that it has Tesla and Starbucks and they have other really good quality tenants, I do want this to be a bigger position in the portfolio. It has been kind of overlooked for a while just because the price was so high. Now it's one of the basement bargain deals in the portfolio, and I do want to take advantage of that if I have the cash flow to do so. Next, I have Lowe's, a dividend king. We have 2 shares, 317.04 is our market value, $100.86 is our average cost. I don't know if it'll ever get that low again. I have 1.55% of the portfolio in Lowe's stock. I wish that was higher, but I bought it with dividends, so it was kind of like a drip thing. I just bought it when I could. And we are up $115.32 on 2 shares, up 57.17. This is one of my rocket stocks that just took off after I bought it. We're up more than $50 a share. Then we have AT&T. They are like my second or third favorite stock of all time. I love them, especially because I wanted to buy Warner, and they picked them up. They scooped Warner Brothers up. So that was exciting. And Warner, when it got bought, was like $37 a share. So you're getting the assets of Warner, DirecTV, and AT&T for the solid price of around $30, about $28. But here's the thing. Warner Brothers alone was worth more than that stock price wise, so it's just crazy to me. I know AT&T has a lot of debt, but when I see that price for the stock, I'm like, it's a fucking steal. So 28.10. I wish I could buy it right now. It is probably my second or third favorite stock of all time. I know I said that, but I love the stock. And I'm dividend efficient in this dividend aristocrat as well. So we have 71 shares, about $2,000 in market value. 30.93 is our average cost. About 9.7% of the portfolio is in AT&T. We are down $200 today, down 9.14%. But again, guys, I know I've said this in past videos, but keep in mind, I'm really okay with being down on this one. This is an insanely good buying opportunity for me because look at this. It was up to like $35 to $38 a share, and now it plummeted down to 28. So if it has potential to go back up that high, it's a $10 upside on the stock and a really killer dividend, as well as the fact that it's below my average cost, so I want to buy up right now if I could. And they have plans to take care. I know a lot of people are worried about AT&T's debt. I'm not. They have a very strategic plan. They're looking at selling less core assets to their business, and they will use that to pay debt off, mainly talking about DirecTV. But I'm excited to see what they do. I know they've kind of lagged the overall market for the better part of the last like 10 years, but that dividend's great. Their cash flow is phenomenal, and they have more than enough cash flow to cover the dividend, and that's really the reason why I love AT&T is I'm not worried about the cash flows. People are, pretty much addicted to their phones like it's nicotine. So I love the business model. I love the moat. So yeah, I love AT&T. Anyways, on to the next stock. Sorry. Then we have AbbVie. I have 60 shares. I bought this during an acquisition. 50, almost $5,200 of market value. Average cost is 72.22. About 25.3% of the portfolio is in AbbVie. We are up $834, up 19% on AbbVie. Then we have a solid dividend king in J&J. 2 shares, market value of about $290. Average cost is 135.79. 1.42% of the portfolio is in Johnson and Johnson. We're up 1934, up 7.12% on Johnson and Johnson. Love them. They're a pharmaceutical destroyer. They're phenomenal. And the diversification that they have with baby products, healthcare products, medications, and even in the hospital, the technology that they have and distribute to hospitals around the world is insane. It's just such a well diversified company, and it's in my top 5 of all time. I love J&J. But yeah, I wish I had bought more. But this is one of those that will be a core position, and I will build toward it. I'm actually planning on using another stock's dividend to buy this in the future. So very bullish on J&J. Next, we have 3M, a dividend king just like Johnson & Johnson. We have 2 shares, 230.84 is our market value. Average cost is 147.28. 1.57% of the portfolio is in 3M. We're up $26.29, up 8.93% on 3M. I love 3M due to the diversification, the dividend status, and the consistency. And the diversification is insane. I don't know if you've looked at all the products. It's kind of like J&J. They're across multiple industries, and they know how to make money. It's crazy. Next, we have a retail giant and Target, another dividend king, which is surprising. Target's actually dividend king, while Walmart is not quite yet, which is funny. 10 share, and actually Target pays a better dividend than Walmart does per share as well. But we have 10 shares, $1,500 of market value. Average cost is $87.68. 7.4% of the portfolio is in Target, and I wish that was higher. But we're up 643.22, up 73.3%. My deal with Target is just like with Lowe's, and it's funny because I wanted to buy more, and I thought about buying more because I bought this right after I learned that it was a dividend king. I bought 10 shares because it's what I could afford at the time. I had less income at the time that I bought the stock, but I'm wishing I bought more now because it took off. But you live and you learn. It's not the end of the world, and I do hope that Target comes back down to a buying level of about $95 before I buy it, but it's gonna be a while. Next, we have Walgreens. We have 6 shares. They're very close to Dividend King status, about 5 to 6 years away. We have 6 shares of Walgreens, 210.24 is our market value. Average cost is a little bit below $40. 1% of the portfolio is in Walgreens, and we're down $29.25 today, down 12% on this stock. But this is one of those that has dropped significantly, and I really do think it's a buy here. It's 64, about 30. You could say 34, about $30 of upside in the stock right now. That's great, plus a great growing dividend. A consistent growing dividend as well for years and years and years and years. So I'm very, very bullish on the company. They are one of my favorites that I currently own for this set of months, and I'm very excited to see them become dividend kings. I have no doubt that they will. It's one of those that it's kind of in the middle where like J&J, Target, and 3M I want to own more of, but it takes a lot to become dividend efficient, like tens of thousands of dollars in those, where Walgreens is a little bit easier. It would only be like $4K to be dividend efficient in them, and I'm willing to become dividend efficient. It's just I am trying to diversify beyond retail because, as you guys saw, I do have realty income, which is mainly retail properties. I have Lowe's, I have Target, and I have Walgreens as well. So I have a little bit more retail in the portfolio than I would like to. But out of those choices, I would choose Walgreens over Target or Lowe's right now, just simply because how low the price is. I think it's a bargain, and the dividend growth history is phenomenal. And the thing is, it's below my average cost, so I'm not going to buy anything above that. So that will be one of those that grows with extra cash. After that, ExxonMobil. I kind of have a similar feeling with Exxon that I do for Walgreens. They are dividend aristocrat. I have 84 shares. about $3,000 of market value. Average cost is 53.20. So as you guys can see, I'm down big, but that's okay. 14% of the portfolio is in ExxonMobil, and we're down almost $1,600 on this, down 35%. That doesn't worry me. In fact, it makes me pretty pumped up to own the stock, because this is a great buying opportunity for me personally. As an investor, this is exactly what you want. As a dividend investor, you want that stock price to go down. And the reason why I'm not freaking out is because I knew when I got into the stock that one of the reasons I got into it specifically was I knew stocks like Johnson & Johnson, 3M, or Target, they don't fluctuate that much, as in their quality. They're very good companies. They're very well run, and they really know how to pay shareholders. They have a great long dividend growth history. So people pay a premium for that, but they also are very stable. Where oil is known for volatility. So the reason I bought ExxonMobil was because, and I thought about Chevron too, oil in general. The reason I wanted it was because when stocks like J&J and 3M, they don't go on sale very often, but I knew with the volatility of oil prices, I figured Exxon or Chevron, which I chose Exxon instead, they would be more volatile, and I felt like there would be more opportunities to buy something like ExxonMobil versus something like a 3M or J&J. Now, I do like 3M and J&J more than ExxonMobil, but due to the volatility, as you can see, I have 84 shares, so it's been more volatile, and I've tried to jump on that volatility and really rake in that dividend money, and really take advantage of the opportunity. Right now I can't do that, which you kind of have to bite the bullet a little bit because I'm not working currently, so I can't throw any more money into it. And honestly, it's a really big position in the portfolio, and I didn't want oil to be that big of a position, but I couldn't ignore it at that point in time, and honestly, I don't think I could really ignore it now. I do want to buy the next stock on the list more than I want to buy ExxonMobil, but one of the things as a dividend investor is, even when you have a plan, if there's a better buy, if it makes more money over time, um, it would make more sense right now to buy ExxonMobil than it would to buy the next stock on the list. But I have gotten a lot of questions on Instagram about whether or not I'm planning on selling ExxonMobil. No, I don't sell for a loss. The only way I would ever sell a stock, like I had to do with Disney and Wells Fargo, is if they cut the dividend to a point that there's no point in having it, as in like it's a 20-cent dividend and the stock is $80. I'm not going to keep it then. Or if they completely cut their, if the dividend gets completely taken out, if they decide not to pay one at all. But right now, ExxonMobil pays about 87 cents. So Walgreens is about the same price. As you saw just now, it's at 35.04. So you're getting double the dividend with ExxonMobil that you do for Walgreens for about the same price. So that's why I'm so bullish on ExxonMobil. As long as they don't cut the dividend and they have enough cash flow to cover that, I really don't see how this isn't a buy. It's definitely a buy for me personally due to the fluctuation. Like I said before, that's the reason I bought this, was because I knew that stocks like J&J, Target, even Walgreens are less likely to go down than Exxon. I felt like that volatility would give me more opportunity, and as you guys can see, it definitely did. So anybody wondering if I'm gonna sell ExxonMobil due to price fluctuation alone? No. I'm long term on ExxonMobil, I'm long term on oil. The only way that I would sell a stock is if it cut the dividend to a point that it no longer made sense to hold the stock. As in, let's say ExxonMobil cuts the dividend by like 80% and only pays like a 34-cent dividend. Well, Walgreens being close in price, pays a 46-cent dividend. So if Exxon's went down to like 32 cents a share, I'd sell out of ExxonMobil and I put it in Walgreens because Walgreens is a better buy. It's going to, around the same price, it's going to compound faster. But right now, ExxonMobil's a steal. And the only way I would sell it is if it cut the dividend lower than something else in my portfolio. So for anybody who is asking, no, I'm not going to be selling due to price fluctuation. That is actually the reason why I'm in the stock in the first place. Next, we have Aflac. So this is my gold stock along. So it goes Coca-Cola, AT&T, and Aflac. So I want insurance in the portfolio, and Aflac is a dividend aristocrat, and that's why I picked it over Travelers Insurance. We have one share. This is kind of a similar story to FRT, actually. I bought this with dividends, and I bought just a little bit because it's easy to double up or quintuple or 20x my position at a better price. So we have one share, 35.67's market value. Average cost is 35.75. 0.17% of the portfolio is in Aflac, and we're down 8 cents. Not worried about that at all. I love Aflac. I love the business model. I love the cash flow that they bring in. So this will be my goal stock. And that rounds out the portfolio. Then we're going to look at our watch list. I'm just going to say whether or not they're a buy. So at $26, this is definitely a buy, and I've had questions about why I switched out Leggett & Platt for this. The reason is because I love Leggett & Platt, but this is a lot more efficient, and I like that it's real estate. So again, as I said before when I talked about, FRT, in FRT, I want more real estate in the portfolio. I want about 25% of the portfolio in real estate. And I do have a couple more real estate stocks on the watch list that I do plan on adding. Realty Income is going to be the biggest position, but I do like Store Capital. I like their tenants a lot. And this is a Buffett-backed stock as well, so I'm very bullish on this company. Um, so yeah, I definitely would buy it here, and this is going to be one of those that it's not going to be a huge position. In fact, out of all the REITs that I have, this is going to be the lowest position in the portfolio. But I see the opportunity. I see a phenomenal dividend, and I really can't ignore it. It's a good buy for the price, and I like the diversity that they bring. Next, Cisco at $61 is definitely a buy. Genuine Parts at 93. I would try to get it closer to 90. So that's not a buy. PepsiCo at 131. About 16. Yeah, about $16 of upside. I need 15, so I'd buy Pepsi there. Kimberly Clark, the toilet paper maker, 146.48. Just enough for me to buy it. Colgate at 75. I'm not touching that. Starbucks at 83. Not touching it. Procter & Gamble 137. Not touching that either. SX is a buy under $200. It's a buy under $300. So under 200, I might sell a kidney. U.S. Bank. Sorry, I keep clearing my throat, guys. I have a little bit of a cold, but I'm not gonna let that stop me from posting a video. U.S. Bank is my personal bank, so I do want to own what I interact with every single day. 34.73. It is definitely a buy. There's like at least $20 of upside in that, like $26, $27 of upside in that. So definitely enough upside there. And it pays a 41-cent dividend with that upside as well. It's just like SX Property Group. There's a good upside in the stock, and it's a good dividend. And I actually use this bank every day, so I want to buy what I interact with. Then we have Black Hills, the utility company for the portfolio. 52.82 is definitely a buy. It's $30 upside in that stock, so, and a great dividend. And they are they're kind of weird. So they're not included in the S&P 500. So in order to be quote unquote a dividend king, you need to be in the S&P. They're not, but they still technically are going to deserve king status within like I think it's 6 or 7 years. Might be even sooner than that. I think they're on like 43 or 44 years of consecutive growth. But even if they hit 50 years, they won't get the king status because they're not in the S&P. But I want them. And also, it's a homegrown stock, so they do gas utilities in Iowa, which is the state I live in. So again, just like U.S. Bank, I kind of want to. I'm a homegrown kid, so I want to get as much exposure to utilities and companies that I interact with every day. And since they do business in Iowa, where the state that I live in, I do want to own them. Next, another real estate play in Mickey D's. So at 216. Only $10 of upside. I'm not buying it, but McDonald's is going to be probably the second biggest holding for real estate. I want it to be Realty Income first because I love them, then McDonald's, then FRT, then SX Property, and then Store Capital. So those are going to be the 5 real estate stocks that I own in the portfolio. And McDonald's is going to be a big one. I love the model. I love the franchise model a lot. I love that they buy land and they make the franchisees pay only lease to them and pay only to them as well. So the reason that I love the business model so much is because McDonald's is not dependent on McDonald's restaurants in those locations. They own the land, so whether it be McDonald's or not, Burger King could be on that land, and they'd have to pay McDonald's. So as long as they own the plots of land, and they keep the franchise model, I'm going to be super bullish. I love the company. I love the business model. So I will buy it. And honestly, this is one of those stocks that it's kind of like Procter and Gamble and Colgate. I know in the past I've said I don't care the price. I don't care if I have the upside or not. I probably would break that rule for Procter and Gamble, Colgate, and definitely McDonald's. Love McDonald's. Then we're on to the growth portion of the portfolio. Apple is a buy with about almost $20 of upside in the stock, upwards of $20. So definitely buying that. Disney definitely buy 20, almost $30, about $30 of upside in the stock. Microsoft at 204, about $28 of upside, definitely buying it there. Facebook has $50 of upside, buying it there. Costco at 338, definitely buying it there as well. So my goal stocks are Coca-Cola, AT&T, and ExxonMobil. So those are going to be, or excuse me, and Aflac. Sorry, it would have been ExxonMobil, but I already feel like I'm too exposed to ExxonMobil, so it's Aflac instead. Sorry. Um, so those are going to be the goal stocks for the portfolio. But the rule is, if I put money in over $1,000, I will automatically buy a share of Realty Income, no matter what, and then I'll buy another stock that will pay me the next month. So like let's say this month I get paid by Altria, right? So I'm going to use Altria's dividends to fund AT&T shares. But let's say so for the month I would be, if I was working right now, I'd be buying $1,000 worth of AT&T shares plus the Altria dividend, and other payouts from that month will make me like, I think it was 5 shares of AT&T. So my dividends will pay for AT&T plus my $1,000 will pay for AT&T, and then any extra cash will be going to Realty Income in another deal. It doesn't have to be AT&T. It could be something like Colgate or something if I had enough cash. But I want to buy the gold stock and then Realty Income with the extras, and if there's anything left over I could buy something else as well. But that's going to be the main goal, is I'm going to focus on the gold stocks and then buy 1 share of Realty Income, and then anything else I'm going to make sure I buy a stock. So like let's say for this month I said AT&T, right? Let's say I don't want to buy another share of AT&T. Like I used MO dividends, I put $1,000 in AT&T. Say I put $1,200 on the market, so I have $200 left. I would buy a share or two of Realty Income, and then I might come down here and buy some Colgate or something if I had enough cash. So I'm going to try to add more stocks to the portfolio, but I do want to focus on my main ones. But any extra cash, I have no problem looking at a deal on the watch list. So just want to let you guys know kind of where my head's at and my plan for this, for the channel and for my investing portfolio. So that's going to be the goal, guys. I'm going to focus on the gold stocks, buy Realty Income like a fiend, and then any other deals I see, I will take advantage of them as well. So thank you guys so much for watching. Remember to make the like button sad, make it blue. And remember to hit the subscribe button on my channel, That Dividend Guy. And when you do, hit the bell notification, because I post a dividend portfolio update every single day, every Monday through Friday. And I started a new series on the channel called Dividend Increase, where I cover companies that announce dividend increases. I want to help newer investors single out those great investments that have paid over time, especially during the pandemic, because the companies that are doing it now are the companies that can do it through and have done it through other recessions. So strong quality companies are the ones that are paying a dividend and increasing it right now. And that's where your research needs to start, is in quality. I also do videos on Warren Buffett's portfolio. I've done videos on Tesla and even EV IPOs if I find them interesting enough. So I do an array of content, and I try to be as consistent as possible here on YouTube. And if you like the stock market, if you like investing, and you like diverse content, this is definitely the channel for you. So thank you guys so much for watching. I'll see you guys tomorrow in another Robinhood portfolio update. Take care, guys.